Yo guys, as you can probably tell by the title and thumbnail, our boy Walt Disney has dropped past all of its supports, and it's hanging out just above $100 per share, with a 26% decrease in the last month and a whopping 10% drop today. Our boy Mickey is having one hell of a ride. So what's going on? Is everyone losing their mind? Or is there a valid reason for Disney to be trading at these fractional levels? So let's take a look. Well, what a lot of people don't realize is that Disney, out of their 70 billion revenue in 2019, 26 bill came from parks, experiences, and products. So what's the big deal? Well, if you haven't heard, due to the CV, their Shanghai, Hong Kong parks have been closed for over a month, resulting in an expected $280 million loss in revenue. On top of this, they've temporarily shut down the Japan parks, and it will certainly be interesting to see how the parks in other regions are affected. I mean, it wouldn't be a stretch to assume another few $100 million loss. Obviously, the magnitude of this financial impact is highly dependent on the duration of the closures. It seems as if the market has priced in a pretty bleak picture regarding Disney's theme parks. Alright, so up next, we're going to talk about Disney's studio section, which brought in a whopping 11 bill in 2019. So let's take a look and see what media will be released under the Disney umbrella in 2020. Luckily, Frozen 2 and Star Wars Saga will be included in the 2020 earnings, which should be a banger. We also have Mulan, The New Mutants, Black Widow, Jungle Cruise, Thor, Black Panther, Guardians of the Galaxy, just to name a few. Certainly a decent lineup for 2020, but nothing that will come close to tickling the chin of Thanos. Perhaps even worse, Disney reported cinemas in China are completely closed and slower than usual attendance in other regions due to CV fear. Alright, the last segment I'm going to go through is Disney's direct-to-consumer business. Thanks to Disney Plus, ESPN, Hulu, this segment is expected to grow an additional 10 bill in revenues. However, this is expected to be a $2.5 billion loss in this segment as they are still in the growth stage. But don't take this the wrong way. This region of Disney's company is by far the crown jewel. And when buying Disney, this is a huge segment you should be watching. Currently, Disney and Hulu have around 30 million subscribers each. And regardless of economic impacts, I can only see that number rising. While this segment is able to prop Disney up to avoid the shortfalls from other segments, well, no. But a majority of this has already been priced into Disney's share. Disney has briefly seen these low levels in the past few years, but realistically, you're getting Disney at the prices you could in 2015, which is really impressive considering all the growth since. Granted, there's a lot to be worried about, but for a company that is so intertwined with our culture and has an impressive $1.68 dividend, which for a company that has such potential growth is pretty impressive. Honestly, it seems like Disney would certainly be worth picking up at these levels. But that's just my take.